Good day and welcome to this presentation on financial instruments. In this presentation, we will be having a look at compound financial instruments as well as the disclosure that is required for financial liabilities. A compound financial instrument is a non-derivative that contains both a financial liability and equity. Examples of this include items such as your convertible debentures as well as convertible bonds. These are financial instruments as they contain a contractual obligation to receive cash, for example, interest, and they come with the option of obtaining a fixed amount of shares. So very important, if the debentures or bonds are convertible into a variable number of shares, they will not be compound financial instruments and they will only be financial liabilities. So the two requirements must be met for it to be a compound financial instrument, being that there is a contractual obligation to receive cash, as well as the option to obtain a fixed amount of shares. Now you might be asking, but how do we account for a compound financial instrument? So you always start with a financial liability. The PV of the financial liability must be calculated using the market-related interest rate of similar instruments that are not convertible. Once you have this, you can calculate the equity portion, which will be the total proceeds that were obtained when the convertible debenture or bond was issued, minus the fair value of the liability that was calculated when we calculated the PV. Okay, so that is a lot of information to absorb. Let's look at the following example to make more sense of it all. On 1 June 2018, Keeper Limited issued 30,000 12% debentures to the public. The debentures have a face value of R5 per share. Interest is payable annually in arrears on 31 May at the coupon interest rate. On 31 May 2023, each debenture is convertible into one ordinary share at the option of the debenture holder, or can be redeemed at their face value of R5 per debenture held. Do you see that these debentures are convertible in terms of amount and not value, as the debentures are convertible for each debenture that is it will be convertible into one ordinary share. So there are a fixed amount of shares attached to the debentures and not a rand value. On 1 June 2018, the prevailing market interest rate for similar debt instruments without a conversion option was 14% per annum. The required states that we need to prepare the journal entries to account for the issue of the debentures for the year ended 31 May 2019. Right, so there is a contractual obligation to receive cash, so we know that we have a financial liability for Keeper Limited. In addition, on 31 May 2023, the debentures are convertible into ordinary shares at a ratio of 1 share for every debenture held. Therefore, the number of shares are fixed. And therefore, we know that we have an equity component and we are dealing now with a compound financial instrument. If we have a look at the classification and measurement, the liability portion will be measured at amortized cost. It will be initially measured at fair value using the market interest rate for similar debentures without conversion. Any transaction costs that are incurred will be allocated in proportion to the liability and the equity components, and the transaction will be subsequently measured at amortized cost using the effective interest rate method. The first step is to calculate the fair value of the financial liability. To do this, you need your financial calculator and you need to put in the following inputs. First of all, you start with n being equal to 5. Remember, that is the number of payments for the entire period. Your payment will be 18,000 Rand. As you can see, your payment is still based on your coupon rate. The future value is 150,000 Rand. Now, the option to convert the debentures is at the option of the debenture holder. Therefore, the future value represents the amount that the debentures will be redeemed for in cash should the debenture holder decide to redeem the debentures in cash and not in shares. However, if the conversion into shares are compulsory, or there is no, so in other words, there is no cash option, or the decision to convert the debentures into shares lies with the issuer, then the future value will be zero. Next, we have our interest that is 14%. Remember, we use the market-related interest rate of similar instruments that are not convertible into shares. And then we compute our present value, which will give us an amount of 139,701. Now that we have the fair value of the financial liability, we can calculate the equity portion. Firstly, we start with the proceeds of 150,000 Rand. Next, we deduct the lease liability being 139,701, which we've just calculated, and this will give us an equity portion being 10,299 Rand. If you prefer to use an amortization table, you could prepare one starting with the fair value of the financial liability, which is 139,701. The interest will be accounted for at 14%. Then you can prepare the journals for the year ended 31 May 2019 and read the amounts from the amort table for the year ended 31 May 2019. When it comes to the journals, the first step is to initially account for the compound financial instruments. Therefore, on 1 June 2018, we will debit bank with 150,000 Rand. We will credit our liability component of the convertible debenture with 139,701 Rand. This is the amount we calculated. And credit our equity component of the convertible debenture with 10,999 Rand. At year end, we need to account for the interest that has been accrued or paid at year end. And in this example, the payments are on the same date as year end. So to account for the finance costs, we need to debit finance costs with an amount of 19,558 Rand. We will credit the liability portion of our convertible debentures with the capital growth amount, which is 1,558 Rand. Remember that the capital growth represents the difference between the amount that has been paid and the finance costs. Next, we credit bank with the payment of 18,000 Rand. As with financial assets, IFRS 7 lays out the disclosure requirements when it comes to financial liabilities. It is very important to note that even though on third year only parts of the disclosure are examinable, but there is a lot more to the disclosure than just the notes you are examined on. As mentioned previously, the notes are there to provide additional information, but in addition to this, also transparency. As a user of a set of financial statements, you would want to know if there are items in the financial statements that carry a lot of risk and have the potential of causing a company to collapse. The standard tries to reduce the risk to the users of the financial statements by having minimum disclosure requirements that they have in place that users need to disclose. And some of these requirements include what measures are in place to deal with certain risks a company may face, such as your interest rate risks, performance risk, market risks, and so forth. On third year, the disclosure is still quite straightforward, as you need to disclose the categories of financial assets, which include your current and non-current portions. It also includes the concentration of interest rate risk of financial liabilities at amortized cost. This is where the company will need to disclose the exposure they have to interest rate changes and what possible effects it could have on the company. Next is the concentration of liquidity risk of financial liabilities. And remember, liquidity refers to the ability to pay debts. And therefore, this represents future cash outflows that affect the company. This note enables users to see what contractual outflows there will be in future and allow management as well as users to determine whether the company will be able to meet the commitments in the short term. This may be useful to users because they would want to know whether or not this company is a good company to invest in. So let's use the same example as in example 1, and we're going to just add some additional information. Kipper Limited manages its liquidity risk by ensuring that the maturities of its assets and liabilities match according to the cash flow needs and that the company has adequate access to credit. Expected cash flow requirements are monitored with rolling cash flow budgets. And then we come to the required, which says prepare the notes to the annual financial statements of Kipper Limited for the year ended 31 May 2019. Your answer must comply with the international reporting standards. Accounting policies are not required. Comparative figures are not required. And you may ignore all tax and share capital notes. Right, so we have been asked to prepare the notes to the annual financial statements. So firstly, we know that we need to disclose a profit before tax note because we have finance costs. Next, the notes that are required by IFRS 7, which are your categories of financial liabilities, and this includes the concentration of interest rate risk as well as the concentration of liquidity risk of our financial liabilities. Next, we are told to ignore tax as well as share capital and accounting policies, so these notes are not required. If we look at our profit before tax note, we have finance costs of debentures, which will be disclosed. And if we look at our amortization table for the year ending 31 May 2019, our finance costs were 19,558 Rand. So, which we then disclose in our profit before tax note. Very important though, the amortization table is just a calculation and it is not disclosure. It also does not form part of disclosure. The amortization tables are there to assist you with disclosure and as they are easy to read the information from and disclose it accordingly. So remember that doing an amortization table does not count as disclosure. Next, we have categories of financial liabilities. So we are dealing with financial liabilities at amortized cost, and therefore the closing balance as at 31 May 2019 will be disclosed under non-current financial liabilities. Remember, as with financial assets, the increase in capital is a shortfall as the installment is less than the interest amount, and therefore the increase in capital will only be paid when the debenture matures and the 150,000 Rand is paid at the end of the term. Therefore, there is no current portion. As the debentures are convertible, it would be useful to the users of the financial statements to know this, as well as what the conditions are relating to it. So it would be useful just to include a little paragraph stating that the debentures are convertible, as well as what is the ratio attached to it, and when these debentures are convertible. Next, we have the concentration of interest rate risk for our financial liabilities measured at amortized cost. Here we need to inform the users how do interest rate changes affect the company and what measures does the company make use of to minimize any of these risks. In this case, the company has no exposure to interest rate changes with regards to the convertible debenture at reporting date, as the coupon interest rate is fixed. Remember that payments are based on the coupon interest rate. The concentration of liquidity risk on financial liabilities. Remember that this deals with the company's ability to pay debts. And therefore, in this part of the note, we will be looking at future cash flows. Therefore, and it will be all and only cash flows that relate to our financial liabilities. If we include our amortization table, but now remember this is just a calculation and does not actually form part of disclosure, I'm purely just including it here to show you how to disclose the amounts from your amort table. If we look at our 31 May 2019, that is our current financial year, but we need to look at future cash outflows. So if we look at our disclosure, it refers to less than 1 year, between 1 and 2 years, and between 2 and 5 years. So between less than 1 year refers to less than 1 year after year end. So in other words, your short-term portion, so this would be up to 31 May 2020. If we look at the amort table, the total cash outflows for 31 May 2020 are 18,000 Rand. Next, it says between 1 and 2 years. So that means more than 1 year after year end, but less than 2 years after year end. Therefore, if we say more than 1 year after year end, it means after 31 May 2020, but less than 2 years, in other words, before 31 May 2021. The total cash outflows for this period is also 18,000 Rand. And lastly, the disclosure refers to between 2 and 5 years. So in other words, more than 2 years after year end, which is after 31 May 2021, but less than 5 years after year end. So in other words, before 31 May 2024. But in this case, the debentures only have 2 years remaining, and therefore it will all be included as it is before 5 years. The total cash outflows for this period will be the 18,000 Rand from 31 May 2022, the 18,000 Rand from 31 May 2023. But don't forget, on 31 May 2023, the debentures could be redeemed in cash for 150,000, and that 150,000 is also a potential cash outflow, which means we need to include it. And that gives us a total amount of 186,000 Rand for the period between 2 and 5 years after year end. Lastly, remember to include how the company manages liquidity risk. So in this example, we'll just say Kippa Limited manages its liquidity risk by ensuring that the maturities of its assets and liabilities match according to cash flow needs, and that the company has adequate access to credit. Expected cash flow requirements are monitored with rolling cash flow budgets. That is the end of this learning unit on financial liabilities. Thank you for watching. Goodbye.